Ever wondered how the Forex market works? Well, let's dive right in. The Forex market, short for the foreign exchange market, is a bustling global marketplace where currencies are traded. Imagine a bustling bazaar that never sleeps. That's the Forex market for you. It operates 24 hours a day, 5 days a week, from the financial hubs of Tokyo to London to New York. Now, who are the players in this global market? It's a diverse ensemble ranging from central banks to financial institutions, multinational corporations, and individual traders like you and me. Central banks, for instance, participate in the market to align their currencies with their economic goals. Financial institutions, on the other hand, trade currencies as a service for their customers who need to buy or sell foreign currency. Corporations, particularly those with an international footprint, participate in the Forex market to hedge against potential losses from currency fluctuations. And then there are individual traders who engage in Forex trading aiming to profit from changes in currency prices. So what's the primary function of the Forex market? In essence, it serves as a platform for the exchange of one currency for another. This exchange happens for various reasons. International trade is one significant factor. When a company in Japan, for instance, buys goods from Germany, it needs to convert its yen into euros to pay the German supplier. Tourism is another reason. Imagine a family from the UK planning a vacation in Australia. They need to exchange their British pounds for Australian dollars. And then, of course, there's investment. An investor in the US might want to invest in an Indian company and would need to convert their dollars into Indian rupees for the transaction. These diverse participants and the market's global reach make it a dynamic and constantly changing environment. Whether it's for trade, tourism, or investment, the wheel of currency exchange keeps turning, keeping the Forex market alive and thriving. But why do people get involved in Forex trading? Well, let's shed some light on that. One of the primary attractions of Forex trading is its liquidity. The Forex market is the most liquid market in the world, meaning currencies can be bought and sold virtually instantly. This liquidity also contributes to the market's stability, making price manipulation more difficult. Then there's the benefit of accessibility. The Forex market operates 24 hours a day, 5 days a week, enabling traders to participate whenever and wherever they please. This round-the-clock availability caters to the different time zones of traders globally. Moreover, the potential for profit in Forex trading is significant. The constant fluctuations in currency values create numerous trading opportunities. And let's not forget about the ability to trade on margin, which allows traders to amplify their trading capacity using borrowed funds. With such benefits, it's no wonder that Forex trading captivates the attention of many around the globe. Now let's demystify the concept of currency pairs. When we talk about Forex trading, we're always talking about trading one currency against another. That's why currencies in the Forex market are always represented in pairs such as EUR/USD or GBP/JPY. Here's a quick breakdown. The first currency listed in the pair is known as the base currency. This is the currency you're essentially buying or selling. The second currency, on the other hand, is referred to as the quote currency. This is the currency used to determine the value of the base currency. For example, in the pair EUR/USD, EUR is the base currency and USD is the quote currency. If the current exchange rate is 1.15, it means you need $1.15 to buy €1. Now let's talk about exchange rates. An exchange rate is simply the value of one currency in relation to another. It tells us how much of the quote currency is required to buy 1 unit of the base currency. So if the EUR/USD exchange rate is 1.15, it means you need $1.15 to purchase €1. Exchange rates fluctuate constantly due to a variety of factors, including economic indicators, interest rates, political stability, and overall market speculation. These fluctuations create opportunities for traders to profit from changes in currency values. Let's take a quick example. Suppose you believe the euro is going to strengthen against the US dollar. You could buy the EUR/USD pair. If the value of the euro rises in relation to the dollar, you'd make a profit. Conversely, if the euro falls, you'd incur a loss. To wrap it up, always remember in Forex trading, currencies always come in pairs. The base currency is the one you're buying or selling, and the quote currency is used to determine its value. Understanding this concept is crucial in navigating the Forex market successfully. Remember, in Forex trading, currencies always come in pairs. Scene script. Most trading volume in the Forex market revolves around the major currency pairs. These pairs involve the mighty US dollar on one side, and they are: firstly, we have the euro against the US dollar, symbolized as EUR/USD. This pair represents two of the world's largest economies. It's highly liquid and popular among traders due to its relatively low spreads. Then there's the US dollar versus the Japanese yen, or USD/JPY. This pair is a favorite among traders who thrive on the pair's volatility, which is often influenced by the economic health of these two powerhouse nations. Thirdly, the British pound against the US dollar, GBP/USD, affectionately known as cable. This pair is known for its significant price movements, making it a popular choice for traders who enjoy volatility. Finally, the US dollar paired with the Swiss franc, USD/CHF. This pair is often a safe haven during turbulent market times thanks to Switzerland's stable economy. These major pairs are the backbone of the Forex market. Beyond the majors, there are also cross and exotic currency pairs. Let's dive into these less commonly traded but equally intriguing pairs. Starting with cross-currency pairs, these are pairs that do not include the US dollar. For instance, you might have come across pairs like the euro against the British pound, represented as EUR/GBP, or the Australian dollar against the Japanese yen, denoted as AUD/JPY. These pairs allow traders to speculate on the relative strength or weakness of currencies outside the realm of the US dollar. One significant advantage of trading cross pairs is the opportunity for diversification. By not being tied to the US dollar's performance, you can potentially capture profits from movements in other currencies. Now, let's shift our focus to the exotics. Exotic currency pairs typically involve a major currency paired with the currency of a smaller or emerging economy. To put this into context, consider pairs such as the US dollar against the Singapore dollar, represented as USD/SGD, or the euro against the Turkish lira, denoted as EUR/TRY. Unlike the majors and crosses, exotic pairs tend to have lower liquidity. This means they may not be as easily traded and can experience larger price swings. This lower liquidity also typically results in higher spreads, which are the differences between the bid and ask prices. However, these pairs aren't all about risks. The potential rewards can be substantial. The larger price swings can lead to significant profits if you're on the right side of the trade. But remember, with greater potential returns come higher potential risks. So whether you're considering trading cross or exotic pairs, it's essential to understand their unique characteristics. They can offer additional opportunities for diversification and potential profits, but they also come with increased risks. As with all trading decisions, it's critical to do your research and understand the market dynamics at play before diving in. And that wraps up our exploration of cross and exotic currency pairs. Trading these pairs can provide additional opportunities, but also come with increased risks. Stay tuned for our next scene where we'll delve into how to read currency pair quotes. Understanding how to read currency pair quotes is a fundamental skill in Forex trading. Now let's delve into the nuts and bolts of reading currency pair quotes. When we look at a Forex quote, we see two prices. These are the bid and the ask prices. The bid price is the price at which we, as traders, can sell the base currency. Picture it as the highest price that someone in the market is willing to pay for the currency at that moment. On the other hand, the ask price, also known as the offer price, is the price at which we can buy the base currency. Think of it as the lowest price that someone in the market is ready to sell the currency at that moment. Here's a simple way to remember this. We buy at the ask price and sell at the bid price. Or in other words, we buy high and sell low. Now, you might be wondering, why are there two prices? Well, the difference between the bid and the ask prices is what we call the spread. The spread is essentially the cost of trading. It's how Forex brokers make their money. The smaller the spread, the less the price needs to move in our favor before we start making a profit. Conversely, a larger spread means the price needs to move more before we start to see a profit. That's why, as traders, We often prefer currency pairs with smaller spreads. They're cheaper to trade. To recap, the bid price is what we can sell the base currency for, the ask price is what we can buy it for, and the spread is the difference between the two, representing our trading cost. Understanding these concepts is like learning the alphabet before writing sentences. It might seem a bit technical at first, but with practice, it becomes second nature. Mastering these basics sets you on the path to becoming a proficient Forex trader. Remember, the journey of 1,000 miles begins with a single step. So take that step today and start your journey towards Forex trading proficiency.